As of today, July 30th, 2026, the stock market is currently closed, and Super Micro Computer Inc., NASDAQ SMCI, closed its most recent regular trading session at $25.70, dropping 9.67% or $2.75 on the day, after opening at $28.02 and reaching an intraday high of $28.07 against an intraday low of $25.68. Most retail traders watching that single-day slide immediately assumed it was just another erratic tech pullback or short-term market noise following broader market fluctuations. The deeper reality reveals something far more consequential for the entire server hardware landscape. While casual investors on popular investing sites focus heavily on top-line revenue headlines driven by hyperscaler data center expansion, institutional desks are scrutinizing an uncomfortable divergence between expanding order volumes and shrinking gross margins. Furthermore, fresh legal developments, including an International Trade Commission investigation initiated by Netlist regarding high-bandwidth memory and DDR5 components integrated into server architectures, have introduced real operational friction at the exact moment the company needs flawless execution to defend its market share. The consensus narrative across retail message boards and popular financial apps like Robinhood and SoFi Invest maintains that if you want direct, leveraged exposure to massive artificial intelligence infrastructure expansion without paying the rich valuation multiples attached to NVIDIA stock, Tesla stock, or Apple stock, Super Micro Computer is the premier vehicle. The underlying logic seems straightforward. As global cloud giants build out dense compute clusters, someone has to assemble, liquid cool, and rack those dense server chassis, making Supermicro an indispensable manufacturing partner. However, a serious look at the structural reality of the server industry challenges that optimistic baseline expectation. Assembling server racks using third-party graphics processors and specialized memory modules is fundamentally a thin-margin hardware integration business rather than a high-margin proprietary software model. When component pricing rises, or when legacy competitors like Dell and Hewlett-Packard Enterprise aggressively cut prices to win major enterprise deployments, hardware integrators absorb the immediate brunt of margin compression. Individual investors who practice self-investing through an individual brokerage account often mistake exploding top-line sales volume for a durable competitive moat, missing how quickly rising input costs can erode actual net profits. A closer examination of recent trading activity highlights intense price volatility and elevated trading volume that traditional market commentary struggles to explain. Daily volume spiked past 40 million shares during the latest sales drop, representing a massive surge over typical baseline activity and pointing to institutional portfolio rebalancing rather than simple retail selling. Over the past month, the stock has traded within a wide band ranging from low $20 levels to mid-$30 territory, reflecting deep disagreement among asset managers regarding fair value. Investors utilizing Schwab Intelligent Portfolios or managing customized asset allocations through Fidelity Wealth Management have watched SMCI experience sharp swings relative to the broader NASDAQ index. This selling pressure comes at a time when macroeconomic headwinds, high capital costs for debt-funded infrastructure upgrades, and tight enterprise IT budgets are forcing cloud providers to negotiate far harder on server pricing. When institutional volume expands rapidly on down days, it indicates that large funds are actively trimming exposure to high-beta hardware integrators in favor of companies with higher free cash flow stability and predictable earnings. The divide in market perception becomes even clearer when examining how different investor groups manage their positions across modern financial platforms. Retail traders engaged in Robinhood stock trading using the Robinhood app or executing active short-term option strategies frequently treat steep pullbacks as automatic buying opportunities, anchored to memories of past rapid rallies. On the other hand, disciplined wealth managers using a Fidelity brokerage account, managing Fidelity mutual funds, or executing trades through an interactive brokers trading platform tend to take a far more guarded posture, carefully analyzing debt maturities, inventory backlog ratios, and working capital cycles. Successful online investing requires filtering out narrative excitement and assessing whether a company possesses structural pricing power. Supermicro undoubtedly gained early market share through its fast modular server assembly and direct liquid cooling architectures, but execution speed alone does not eliminate customer concentration risks or margin pressure. When a substantial portion of overall revenue depends on a handful of massive hyperscale customers, any shipment delay, supply constraint, or shift in supplier allocation immediately impacts quarterly financial results. Comment below how many shares of Supermicro you currently hold in your individual brokerage account and whether you view this recent drop as a long-term buying opportunity or a sign of deeper structural headwinds. To evaluate where Supermicro stands going forward, it helps to review how its fundamental operations function beneath daily stock swings. The company specializes in high-performance server and storage systems built around open modular architectures. Headquartered in San Jose, California, with manufacturing and assembly operations spread across Silicon Valley, the Netherlands, and Taiwan, the business builds customized hardware optimized for compute-intensive workloads, such as artificial intelligence training, enterprise cloud hosting, edge computing, and large-scale data storage. Their product catalog features advanced blade systems, multi-node rack-mount units, and specialized liquid-cooled enclosures designed to handle high thermal densities. Historically, their core advantage was rapid engineering agility, allowing them to bring server solutions integrated with newly launched chips to market faster than traditional enterprise hardware suppliers. However, as rival hardware vendors expanded their own liquid cooling manufacturing and streamlined supply chain execution, Supermicro's lead in speed narrowed, forcing it to compete more directly on price, delivery timelines, and balance sheet flexibility. Past performance and historical financial reporting patterns offer essential context for today's market debate. In earlier market cycles, the company operated as a steady, moderate-growth hardware supplier carrying modest valuation multiples. As global demand for high-density compute infrastructure accelerated, annual revenues grew at an extraordinary pace, propelling the stock to historic highs before accounting adjustments, delayed annual filings, and governance questions triggered severe downside volatility. Although the company resolved key filing compliance hurdles and maintained its public market listings, that turbulent period left institutional investors far more vigilant regarding internal accounting controls, working capital management, and gross margin reporting. When seeking investment help, managing Fidelity IRAs, or researching online investment options, experienced financial advisors frequently emphasize that historical revenue momentum should never be confused with long-term balance sheet stability. Today, equity analysts demand clear proof that the business can convert record order backlogs into stable and expanding net profit margins, rather than merely passing along expensive third-party hardware with minimal incremental markup. Looking toward future market cycles, several distinct operational catalysts, legal risks, and competitive forces will dictate whether the stock can rebuild momentum or remain constrained in a lower valuation channel. The primary positive catalyst centers on the worldwide transition to next-generation liquid cooling infrastructure. If cloud providers accelerate the adoption of direct-to-chip liquid cooling systems, where Supermicro holds deep engineering experience, top-line growth could once again outpace current market projections. Additionally, if operational improvements across European and Asian facilities produce higher manufacturing efficiency, operating margins could rebound faster than bears predict. Conversely, legal complications pose a real risk. The ongoing International Trade Commission patent investigation regarding high-bandwidth memory and advanced DDR5 components could result in import restrictions or licensing liabilities if disputes resolve unfavorably. Furthermore, persistent price competition from well-capitalized industry rivals threatens to keep profit margins compressed, and any slowdown in overall enterprise tech spending would directly hit server order momentum. For self-directed investors constructing balanced portfolios through a self-investing strategy, navigating a high-beta stock like Supermicrocomputer demands strict risk management. Whether you manage active trades through SoFi Active Investing, explore SoFi stocks and SoFi ETFs on the SoFi trading platform, acquire Robinhood fractional shares, or trade complex derivative structures via an interactive brokers platform, maintaining sensible position sizing is critical. Allocating an excessive percentage of total capital into a single server integrator exposes an entire account to acute single-stock volatility and unexpected sector shocks. Utilizing automated portfolio tools such as an intelligent portfolio, exploring Schwab Intelligent Portfolios, or diversifying across broad tech index funds, Fidelity ETFs,